Good evening, everyone. On behalf of NSC, I'm Mihir Moge, your host for today's session. Would like to invite you all for our webinar on understanding passive investing, ETF and index funds. And our speaker for today's session is Mr. Mukesh Agarwal, CEO and NSE Indices and NSE Data Analytics Limited. We welcome sir for today's session and thanks sir for taking your time for a session. Um, so now, without wasting any more time, I would request Mukesh sir, to take over the session. Over to you, sir.
Thanks, Mir, and a good afternoon to all the participants. Thank you very much for taking time out today to come to attend this webinar series, which we have recently started. In today's session, we will be talking about the basics of passive investment. As all of us know, passive products are becoming popular and the preferred investment avenue of investors. All of us keep hearing about passive investments when we meet friends, social circles, newspapers, media. We have started seeing a lot of ads on the TV channels about ETFs, about index funds. So we thought, why not have a session, start a series on passive investment, because we keep getting a lot of queries from the investors. What exactly are passive investments? Should I invest in passive investments? If I want to invest in passive investment, how should I go about it? And just to talk about, before I move forward to my presentation, just to show how popular these passive investments or passive products are becoming. So if you look at the first 10 months of the current financial year, that is April 21 to January 2022, in the first 10 months of the current financial year, about 52 passive products have been launched in the first 10 months. And if you look at the incremental inflows into these passive products, incremental inflows has been around 90,000 crores in the first 10 months. So that's really speaks volumes about it. And today, passive products or passive funds account for 12% of the total AUM of the mutual fund industry, which is around 38.8 lakh crores. And if you look at the number of folios for the passive products, today we have around 1.12 crore folios for the passive products, and out of which 90 lakh folios have been created in the last 2 years. These numbers just show the increasing popularity of the passive products. Accordingly, NSE is organizing webinar series on passive investing to create awareness about the passive investments. And today is the first session wherein I will be talking about the basics of passive investments. Just one. Yep. So the content of today's presentation, I'll be talking about what are the differences between passive and active funds, what are the instruments under passive funds, what are the features of ETFs and index funds, what are the differences between ETFs and index funds, and how to select an ETF or index fund. So let's come to what are passive and active funds. Yeah, so what are the differences between passive and active funds? All of us keep investing in various mutual funds. We keep hearing about XYZ large cap funds, XYZ mid cap fund, XYZ flexi cap funds. So we keep hearing about all the funds. Those are typically the active funds. And what are passive funds and active funds? Let's start with the differences between the two. So if you look at the objective, what is an objective of a passive fund? The objective of a passive fund is to give returns in line with the market. What exactly I mean by that? Basically, the passive funds invest in a particular index. So we'll talk about it more in detail. So basically, the idea is the passive funds, their aim is to give the returns in line with the returns of the index. Wherein if you look at the active funds, they aim to beat the market. Their objective is to outperform the underlying index. Like suppose you have a large cap fund, so they will try to beat the Nifty 100, which is the large cap index. If you look at a mid cap fund, they will try to beat or outperform the Nifty 150 mid cap index. Or if you look at the small cap fund, they will try to outperform the Nifty 250 small cap index. Now, strategy, what is the strategy followed by a passive fund? The passive fund is, they have a hands-off approach. That means that the fund manager don't take any active calls on the investments. They blindly follow the index. That means that they invest in the underlying securities which are part of the index. I will talk about it more in details as we move forward. Whereas in active funds, the fund managers, they manage the funds actively. They take the calls, what stocks to invest, what stocks to sell, what stocks to buy, what sectors to take exposure to. So there are a high amount of active decisions taken by the fund managers. Now, coming to the performance of the passive funds is linked to the index underlying the asset class. So basically, if a passive fund is investing or linked to Nifty 50, so the performance or the returns of the passive fund linked to Nifty 50 will be in line with the Nifty 50 index returns. Whereas in active funds, the performance is linked to the skill and knowledge of the fund manager. The skill sets of the fund manager play a very important role, whether the active fund outperforms or underperforms the index. So coming to the cost and fees, the passive funds, I think that the biggest advantage of passive funds is the cost. The fund management fees of the passive funds is very, very low. It can start anywhere from 5 basis points, 6 basis points, and can go up to 40, 50 basis points or 0.5%, 0.05% to 0.5%. Whereas in case of active funds, the range could be 1% to 2%. So herein you can clearly see that the cost, the fund management fees for the active funds is very high. And what role does the fund manager play? The fund manager has limited role to play in the passive funds because their investment strategy is linked to the index. So as I mentioned earlier, whatever the index is investing in, or whatever the constituents of index, the fund manager will invest in those stocks as the underlying index. Whereas if you come to the active funds, the fund manager is actively involved in taking the decisions of what to buy, what to sell, where should be the exposure be high, where should the exposure be low. And coming to returns, as I mentioned earlier, returns in case of passive funds, they are very much in line with the underlying index. Whereas in case of active funds, the returns are varying. They do not depend on they are not linked to the index, but it depends on the judgment and skill of the fund manager. So as I mentioned earlier, in active funds, the fund managers try to outperform the index against which they are benchmarking the performance of the fund. Now, here is coming to, because I have been talking about underlying index, etc. I'm sure a lot of you would have got confused. So let's basically jump to exactly what is passive funds and what exactly they do. So what are the instruments of passive funds? So passive funds, probably not many of you would have heard, but there are two kinds of instruments which come under passive funds. One is index funds and other is exchange traded funds. So these are the two things. And what do they do? As I mentioned earlier, they invest money, exactly the same stocks with identical weightages as that of the underlying index. So to make this thing clear, suppose there is an index fund or an ETF which is tracking or which is using Nifty 50 as an underlying index. So what that index fund or ETF do, that index fund and ETF will invest in the same 50 stocks as the underlying Nifty 50, which has got 50 stocks and in the same weightages. So what do I mean by the weightages? Suppose in Nifty 50, let's say HDFC Bank has got 10% weight and Reliance has got 9% weight. I'm just giving hypothetical. This need not be the accurate weights, basically. So if the weight of HDFC Bank is 10% and Reliance is, let's say, 9% and TCS is, let's say, 8%. So when the fund manager invests 100 rupees in Nifty 50 ETF or Nifty 50 index fund, so what he or she will do, they will invest out of those 100 rupees, 10% in HDFC Bank, because the weight of HDFC Bank in Nifty 50 is 10%. Then they will invest 9% in Reliance Industries, because the weight of Reliance Industries in Nifty 50 is 9%. And they will invest 8% of that money, or that is 8 rupees, in TCS, because the weight of TCS in Nifty 50 is 8%. So just to make it clear, this 10%, 9% and 8%, I have mentioned it for an example purpose. This need not be the exact weightages of these three stocks in Nifty 50 as on date. So what the fund manager does, they will buy the same 50 stocks as in Nifty 50, and they will invest the money in the same weightages as per the weightages of these 50 stocks in Nifty 50. So what are the underlying indices? So basically today, if you look at it in index funds, passive products, both in index funds and ETFs, they are available across different asset classes. It could be in equity. We also have passive products, that is index funds and ETFs, available in fixed income. Then you also have for gold. And recently mutual funds have launched ETFs on silver also. Then we have ETFs and index funds available for world indices also, like NASDAQ 100, Hang Seng, S&P 500, S&P 500, top 50. So there's a variety of indices on which this ETFs and index funds are available. So for equity indices, the equity index funds and ETFs, the underlying indices could be Nifty 50, could be Nifty Next 50, could be Nifty Bank, could be Nifty Private Bank, all kinds of equity indices which are available in the market. Similarly, for fixed income, the most popular is Nifty Bharat Bond Index, which is the most popular. So similarly, we have other Nifty indices also on which fixed income index funds and ETFs are available. Similarly, gold prices are used to create gold ETFs or fund of funds. And basically, you also have silver. Silver prices are being used to create silver ETFs. And then for world indices like NASDAQ 100, S&P 500, they are used for creating global index funds and ETFs. So now, as I mentioned earlier, ETFs are available in different categories. So today, if you look at India, so we have ETFs and index funds in equity, debt, and gold. Equity is the most popular. Equity accounts for almost 81% of the total AUM. So today, if you look at total AUM of the industry is approximately rupees 4.58 lakh crores, out of which 81% is in equity passive product, equity index funds and ETFs. And debt accounts for approximately 5%. Sorry, debt accounts for 14%, and gold is approximately 5%. Now, some of you would ask us, what exactly is the difference between ETFs and index funds? Now, there are a few differences because, as I mentioned earlier, both ETFs and index funds, they track an index. So today, if you look at, we have 19 ETFs tracking Nifty 50. Sorry, we have 17 ETFs tracking Nifty 50, and we have 19 index funds tracking Nifty 50. So you have both index funds and ETFs available on the same Nifty 50. The question which most of you will ask us, what exactly is the difference between ETFs and index funds? Now, the first difference, main difference is when you want to buy and sell an ETF, it is being done through a stock exchange. So basically what I mean by stock exchange, just like an investor buys Reliance or any other stock, HDFC Bank, TCS, or any other stock from an exchange through a broker. Similarly, ETFs are also bought through a stock exchange platform through a broker. Whereas in case of index funds, one has to buy directly from the fund house. The way we buy any normal active fund, we buy from the fund house. Similarly, the index funds are also have to be bought through the AMCs, the fund houses. Now the prices, in case of ETFs, as I mentioned earlier, the ETFs are traded on the stock exchange. They trade throughout the day. So the markets, when they open from 9:15 to 3:30, so that they are traded on the stock exchange. The bid and ask, the bid is buying price and selling price are available. So the prices are available in the stock exchange, and the price at any given point of time is linked to the NAV. What is NAV? Is the net asset value. And so the net asset value will vary throughout the day depending on the market movements. As the markets move up and down, or the stock prices move up and down, the NAVs also move up and down, and accordingly the price of the ETF will also be linked to the NAV. So let's take an example. When the markets at 9:30 or 9:15, when the markets open, Nifty 50, let's say, has gone up by 2%. So similarly, the live NAV typically should go up by 2% on that day as compared to the closing NAV yesterday. And the price of that ETF typically should be up by around 2% as compared to yesterday's price. Now, in case of index funds, as I mentioned earlier, we have to buy index funds from the mutual funds, from the fund houses. And like any other active fund, in index funds also, the units are allotted to an investor linked to the end of day NAV. So the prices are typically constant. Prices are fixed for the day. The allotment is done based on the end of day NAV. Whereas in case of the ETFs, the prices fluctuate in line with the movement in the index values. If the index values is up by 5%, 2%, 3%, the ETF prices will also vary. If the index goes down, the prices will also go down. Now, if you have to summarize the differences between ETFs and index funds, one is in case of ETFs, real-time trading and pricing is available throughout the market hours. Whereas in index fund, that is not available. As I mentioned earlier, we buy the index funds from the mutual funds and it is allotted to an investor, or a redemption happens at the end of day NAV. And one can put limit orders also, because like any other normal cash trading, if someone wants to put a limit order, that can be done on ETFs because they're available on the stock exchange platform. Whereas in case of index funds, that cannot be done. And as I mentioned earlier, it can be traded on the stock exchange. So you can trade on the ETFs in the real time, whereas in index funds, one cannot trade real time. Is arbitrage possible between futures and cash markets? Yes, it is possible in ETFs, whereas that is not possible in index funds. In fact, arbitrage using ETFs is very, very popular in the global markets, and India is just started. Now, is diversification possible with a single unit? Yes, both through ETFs as well as index fund, diversification is possible. And why do I say so? Because as I mentioned earlier, ETFs and index funds, they replicate an index. So just by buying one unit of Nifty 50 ETF, or by investing limited amount of money in index fund, an investor gets an exposure to 50 stocks which are part of Nifty 50. So that is the beauty. By buying a single unit, by investing a limited amount, I get an exposure to all the 50 stocks or linked to Nifty 50. If I'm buying an ETF linked to Nifty 50, or if I'm buying an index fund linked to Nifty 50. Is intraday trading possible? Yes, intradaying is very much possible in ETFs, whereas it is not possible in index funds, because as ETFs trade on the stock exchange, one can buy and sell throughout the day, whereas in index funds, they are redeemed or invested or allotted at the end of day NAV, so one cannot trade intraday. Exit load, there is no exit load on ETFs because we are trading on ETFs on the stock exchange platform on the real-time pricing, whereas in index funds, different mutual funds can have different exit loads and norms, so exit loads may be applicable over there. Now, ETFs, as I mentioned earlier, ETFs one has to buy and sell through a stock exchange. To hold ETFs, an investor would need a demat account, whereas for index funds, one does not need a demat account. One can buy the units, and units will be allotted, and a physical statement will be sent to the investors the way it is done for normal funds. So the next question is, what are the features of ETFs and index funds? Basically, active funds, if you look at as I mentioned in my earlier slides, in case of active funds, the fund managers try to outperform the benchmark indices. So today, if the large cap funds, they are benchmarking against Nifty 50 or they're benchmarking against Nifty 100, so the fund manager would try to outperform the index. Whereas in passive funds, they try to replicate the performance of the underlying benchmark index. Now, what we have seen, basically, there have been a lot of studies, and people keep talking about those studies in the public domain. So there was a study by moneycontrol.com which says that out of 29 active large cap funds, only 4 have beaten Nifty 50 over a cumulative period of 5 years. So this is a very important thing. While the objective of the active fund managers is to beat the underlying index, whereas in actual, if you look at the actual data as per studies done by independent third parties, only 4 out of 29 active large cap funds have beaten the Nifty 50 over a period of 5 years. Even when we have done studies internally at NSE and we have looked at data of active large cap funds over last 10 years, and our data shows that on an average over the last 10 years, about 60 to 65% of the large cap funds have underperformed the Nifty 50, the returns of the Nifty 50. So that is as per our study. I think this is a very important point. And if you look at it, as I mentioned earlier also, the expense ratios of the passive funds is very, very low. In the case of passive funds, it could be anywhere between 3 basis point, 4 basis point, going up to 0.5, 0.6. 3 basis point is 0.03%. 5 basis point is 0.05%. So ranging from 0.03, 0.05% to 0.5%. Whereas in case of active funds, it could be anywhere between 1 to 2%. So I think this is very important. So while some of you might say that, yes, the yearly difference could be around 1.5%, but if an investor holds on to these investments for a period of 10 years, then 1.5% difference in cost over a 10-year period could result into around 15 to 16%. So that is a significant difference, which cost can additional, basically the expense ratio can result into or can impact the returns of the investors. So here I would like to give a quote, which is by John Bogle, who is the founder of Vanguard. Vanguard, as all of us know, is one of the largest mutual fund globally. And he says that where returns are concerned, time is your friend. But where costs are concerned, time is your enemy. I repeat, where returns are concerned, time is your friend. Where costs are concerned, time is your enemy. So that's what I said just now, that if 1.5% difference in cost, fund management fees yearly can result into a difference of approximately 15 to 16% over a period of 10 years, which is really significant. Now, transparency, this is again a very important point. As I mentioned earlier, in case of passive products, the fund managers replicate the underlying index, and the constituents of all the index are available in public domain. The weights are also available. So if you look at it, there is full transparency. An investor knows if I've invested in Nifty 50 index fund or Nifty 50 ETF, what are the 50 stocks in which the fund manager will invest. Whereas in case of active funds, as I mentioned earlier, the fund managers take the active call in which stocks to buy, what stocks to sell. The portfolio is disclosed once in a month, and portfolio is known only at the end of the month. So there is total transparency about the portfolio, which are the stocks in which the passive fund has invested. Now, low entry barrier, this is again a very important point, because just by paying a small price, let's say today, Nifty 50 ETF trades at approximately, let's say 190, 200 rupees, hypothetically. So by investing 190, 200 rupees, or paying a price of a pizza would cost around 190 to 200 rupees. By paying 190 to 200 rupees, I'm getting exposure to top 50 stocks of the country. I think that is what is the beauty, that even by investing small amount, I get a diversified portfolio, and I can invest in 50 stocks at a time just by investing 190 to 200 rupees. And simplicity and ease of use, I think the entire buying and selling can be done online on any trading platform. And because, as I mentioned earlier, ETFs are traded on the stock exchange, one can buy and sell through the brokers. And similarly, for buying index funds, one can, through the distributors or through the other platforms available in the market, one can invest in the index funds and buy or sell through the mutual funds. Now, I think the question which people keep asking us, how easy is it to buy or sell ETFs in the stock exchanges? Can I buy and sell at the right price? How closely is the ETF tracking the index? Will the ETF underperform the index? I think these are the questions which we keep getting from the various investors whenever we meet them. So we just thought it is good for the investors to know how to select an ETF and how to select an index fund. Now, one is size of the fund. The larger the fund, larger the size, the better it is. Second is trading volume. Trading volume is more, I would say, relevant for ETFs. Higher is the trading volume, better it is, because the ETFs which have high trading volumes, it becomes that much easier for an investor to buy and sell ETFs, that particular ETF. So today, if you look at it, today we have in Nifty 50, we have 17 ETFs. So if someone wants to invest in Nifty 50 ETFs, one should look at one of the criteria is how are the trading volumes in that particular Nifty 50 ETF, and that should be one of your criteria to decide which ETF to buy among the 17 ETFs, Nifty 50 ETFs which are trading on the stock exchange. Third is tracking error. Lower the better. So what exactly do you mean by tracking error? Tracking error is basically, to put it very simply, it is difference in the returns between the index and the underlying ETF or the index fund. So let's say over a period of 1 year, and there is Nifty 50, and Nifty 50 has given total return has given 16%, and the underlying fund has given, the index fund or ETF has given returns of 15%. I'm just giving you very simple this thing. The returns would be tracking error would be approximately 1%. So the lower is the tracking error, the better it is. Means the lower is the tracking error, closer will be the returns of the underlying of the index funds and ETFs to the underlying index. I think that is what one should look at tracking error. And the question you would ask, where is the data available? All the mutual funds, they disclose the tracking or of the tracking errors of all the passive products. Now, the fifth point is bid-ask spread, which again is more relevant, only relevant for ETFs, because this is for the ETFs which trade on the exchanges. Bid and ask. So what exactly is the bid and ask? Bid is the highest price. Bid is the highest price bid is the lowest price. Bid is the price at which an investor is willing to buy, and ask is the price which an investor is, or the quoter is willing to sell a particular ETF or a stock. Basically, the lower is the difference between the bid and ask, the better it is. Basically, the lower will be your impact cost. Now, the last is the expense ratio. And as I mentioned earlier, as all of us know, different funds have different expense ratio. So if you have to choose amongst different ETFs on the same index, so one should prefer the index fund or ETF which has got the lower expense ratio, because I need not explain it further, which will be better for you because that will be the lower cost for you. So this slide talks about so basically, as I mentioned earlier, passive industry has really become very, very significant. And this slide talks about the few of the top indices on which Nifty indices on which ETFs are available in the market, and what is the AUM. So if you look at Nifty 50, Nifty 50 has got 17 ETFs available in the market, and total AUM is approximately 1.69 lakh crores. Then next is Bharat Bond Index. Bharat Bond Index has got 5 ETFs, and the total AUM tracking Nifty 50 Bharat Bond Index is 44,000 crores. Third is Nifty Bank. Nifty Bank has got 9 ETFs. The total asset under management is approximately rupees 28,000 crores. Next is Nifty CPSE, 1 ETF, AUM is 17,000 crores. Nifty IT, approximately 6 ETFs, AUM of 5,000 crores. Nifty Next 50, 6 ETFs, 4,000 crores. Nifty One Day Rate, this is more of money market instrument wherein people park their short-term overnight funds, which is around 4,000 crores. Nifty Private Bank, there are 3 ETFs tracking Nifty Private Bank Index, which is around rupees 2,600 crores. And there are other 43 ETFs tracking various other Nifty indices where the AUM would be 12,200 crores. So this is the idea of this slide, is to show that there is a variety of indices on which ETFs are available today. And if I share some data with you, so today, if you look at it, there are approximately 115 ETFs. Total, if you look at it, there are approximately 196 passive products which are available. And if you look at the breakup of 196 products, index funds would be 68, gold ETFs are 11, and debt and equity ETFs are 115, and silver ETFs is 2. Now, if you look at the number of indices on which equity ETFs are available, there are approximately 41 indices on which various equity ETFs are available. There are 13 debt indices on which debt ETFs are available. So there is a wide variety of indices on which ETFs are available. Similarly, there are 68 index funds on variety of indices. Like as I mentioned earlier, you have 19 index funds on Nifty 50, then you have Nifty Bank, you have Nifty IT, you have various indices on which you have index funds also available. So for an investor, there is a wide choice. Investors can very comfortably and conveniently use ETFs and index funds for creating a diversified portfolio. Now, question is, as I mentioned, just to summarize, what do investors prefer? Basically, why do the investors prefer passive funds over active funds? One is performance is linked to the underlying index in passive funds as compared to active funds. Active funds, they might give you higher returns or they might give you lower returns as compared to the index. Transparency of folio, as I had mentioned earlier, the passive funds, they invest as per the constituents and the weights of the underlying index, whereas in case of active funds, we get to know the folios once in a month. So during the month, we don't know which are the stocks in which they've invested and under what weight. And then third is, it is very simple and easy to use, whereas in case of active funds, the cost of funds, etc., is very high. Again, in entry barriers in passive funds are very, very low. So I think this is the first slide which I had shown, mission accomplished. I think the questions and queries on all the passive funds, what exactly it is and how it is different from active funds. So we have tried to sort it out. Otherwise, overall, if you look at passive industry has really becoming very, very significant in India. The total AUM today is approximately 4.58 lakh crores. And if you look at the breakup of the same, 4.5 lakh crores is around index funds would be approximately 50,000 crores. ETFs, debt and equity ETFs is approximately rupees 3.5 lakh crores, and gold ETFs is approximately rupees 18,000 crores. And if you look at the flows into the industry, last 10 months from April 21 to January 21, approximately approximately 63,000 crores of fresh inflows have taken place in ETFs, and are approximately 27,000 crores of inflows have taken in the index funds. So approximately 90,000 crores of inflows have taken place into the passive funds industry in the first 10 months. And as I mentioned earlier, about 52 basically ETFs and index funds have been launched in the country in the first 10 months of the current financial year. Thanks. Happy investing. So now we'll open the house for questions.
Thank you, Mukesh sir, for an insightful presentation. Now we'll proceed to the Q&A session. So we have already received some questions. So if you still want to raise questions, you can type it in the chat box, and we'll try to cover your questions. Thank you, sir.
Thanks.
Okay, so I will go through the questions one by one because we have got a lot of questions. I can see more than hundreds of questions now. One common point which multiple people have asked is that can we send the presentation or can we upload this presentation somewhere? So yes, we will upload it on the NSE's website, and we are also recording this session, so that will also be available on YouTube. So you can refer to it either through NSE's website or through YouTube. Second, the first question which I would like to take is, few people have asked, like, if they are investing in ETFs or selecting ETFs, how should they go about it, and what are the key parameters for selecting either ETFs or index funds? What should be the key parameters?
Okay, I think as I mentioned in my slide, one most important thing they should look at is first of all, you have to decide on which is the index in which you want to invest. So suppose an investor has to decide whether I want to invest in large cap, I want to invest in mid cap, I want to invest in small cap, or I want to invest in sectoral. So if I want to take an exposure to large caps, then Nifty 50 ETFs or index funds or Nifty 100 ETFs and index funds would be relevant. If I want to invest in mid cap, then mid cap, basically any index which is a mid cap, Nifty 50 mid cap, Nifty 150 mid cap. So one has to decide which is the asset, which is the category in which one they invest, or they want to take an exposure to the banking sector, then any ETF or index fund tracking Nifty Bank would be relevant. That is one. Now, let's say I have decided I want to invest in Nifty 50, and we have, as I mentioned earlier, we have 17 ETFs and we have 19 index funds which are available on Nifty 50. Now, if I have to choose which one, the most important, I would say, is the expense ratio. First, select the fund which has got the lowest expense ratio. Now, coming to ETFs, second thing is look at what are the trading volumes. So all the ETFs trade on the stock exchange. If you go to the exchange website, you can see what are the trading volumes. So look at the trading volumes. That is very, very important, because higher is the trading volume, easier it is for the investor to buy and sell those ETFs. That is second. So third thing is look at the bid ask price of that particular ETF, and also I would say go to the mutual fund website and look at the live NAV. As per the requirement, most of the mutual funds, they publish live NAV of all the ETFs which they have launched in the market. So when we are buying ETFs, we should always make sure that my ETFs trade closer to the live NAV of the underlying ETFs. That is very, very important. Suppose so that is one. So try to buy the ETFs which is trading live or closer to the live NAV, because that plays, otherwise that will be a cost. If the live NAV is 190 rupees and if I land up buying an ETF at 192, 193, so my cost of purchase has gone up by 3 rupees. So that is another thing which we really need to keep in mind. Third is look at the tracking error. The performance of that will be applicable in case of both index funds as well as the ETFs. The tracking error, difference in returns between the ETF or index funds vis-a-vis the underlying index. Lower is the tracking error, the better it is. And as I mentioned earlier, tracking error is available on all the mutual funds websites. I think these are the 3-4 things which we should look at before deciding which ETF or index funds to buy.
Sure. So the next question is, if somebody is wanting to invest in ETFs or index funds for the very first time, which underlying indices would be appropriate to start with?
That's a very interesting question. I think, again, as I mentioned earlier, one has to look at what is their investment strategy, whether they want to take exposure to large cap, mid cap, sectoral, and based on that, they should decide the underlying index. So for novice, for a new entrant on investing for the first time, my advice to you would be, that is my personal advice, and I think you have to make your own decision and take your decision based on your choice, but go for a broad market based index like Nifty 50, Nifty 100, and start investing that, or Nifty Next 50. Nifty 50 is the top 50 stocks. Nifty Next 50 is the next 50, 51st to 100 stock, or Nifty 100, which is the top 100 stock. So start with the broad indices, and then gradually you can go to mid cap and sectoral indices.
Okay. Another question is, can an ETF ever get delisted in India?
I think that is, I would say that will depend on the mutual fund, the fund house which has launched the ETF. If they don't see too much of volume, they don't see too much of inflows coming into the fund, and there will be some SEBI regulations on that, then they have to comply with the regulations. Based on that, they can decide. But till now, we have not seen any ETF getting delisted. But that is a probability which is possible.
Okay. Okay. So another question is, how do you buy index funds? Are they quoted like ETFs?
See, as I mentioned earlier, index funds, one has to buy directly from the mutual funds. You can go to their website, buy directly, or you can buy through your distributor, and they are allotted to you, or allotment in case of buying, the allotment is done at the end of day NAV. And in case of redemption is done at the end of the day NAV. So during the day when you place an order, you will not know at what price you will get or at what price you will be selling your index funds. So that is a call you have to take. So at the end of the day, depending on how the markets have moved, your purchase or redemption pricing will be decided based on the end of day NAV.
Thank you. So another question is, for office going people, working professionals who doesn't get time to check markets on a daily basis, should they prefer ETFs or index funds?
I would say both are equally good. One has to decide what they want to do, because in case of index ETFs, one can place the order and leave it and then it will get executed. In case of index funds, you will get an end of day NAV. So depending on what your choice is, I think I would say both are equally good.
Okay. One question on your John Bogle quote. So somebody is saying, can you please phrase that quote again? When it comes to money, what was that?
Okay. No, I think John Bogle's quote is where, let me say it again, where returns are concerned, time is your friend. But where costs are concerned, time is your enemy. So basically, in nutshell, what he is saying, the longer you are the longer period for which you invest, the returns will be good. But if you are investing in something which is costly and you are invested for a longer time, so that works against you. So that's what the quote says.
Okay, sure. Now the another question is, in this presentation, we spoke a lot about indices, different types of indices and all. So what is the role of index provider and exchange in developing ETF market or ETF ecosystem?
Okay. So basically, coming to the role of the index providers, I think index providers play a very, very important role in the case of passive products. As I mentioned during my presentation also, the index funds and ETFs, they track the underlying index. So, and the index is constructed by the index players like NSE Indices, which is a subsidiary of NSE. So index players play a very important role. So, and as I mentioned earlier, of late, a lot of new ETFs and index funds are being launched. And so the index players work very closely with the ETF or index fund manufacturers, which are the fund houses. One is, we already have a basket of indices on which ETFs have been created, which are available in the market on ETFs can be created. Second is, we also are in continuous dialogue with the mutual funds to create new kinds of indices, especially in the case of, if you look at the debt index funds or debt ETFs, whatever products have been launched, all products are unique in the sense that each is has an index which is different from the other. And I think the other role is, whenever we are creating indices for launch of index funds and ETFs, one very important criteria for us is to ensure that whatever index we are creating, they should be replicable. If we create an index which the fund managers can't replicate easily, that means that it will create problems for the fund managers to track the performance of the underlying index. And in that case, the tracking errors will be very high. That is one. And second thing is also, whatever theme on which we are creating an index, the index should be representative of that particular theme. So suppose we create a Nifty 50 or Nifty 100, we are saying it's a large cap. That index should represent the performance of the large cap. Similarly, when we are created Nifty Bank, we have to ensure that Nifty Bank represents the banking sector and it gives the returns which are in line with the overall banking sector listed on the stock exchange. I think these are the two main things which we perform as an index provider.
Okay. Someone has asked, what happens when there are no buyers for the ETFs we have purchased? So how do we sell it or how do we redeem it?
I think there are ETFs, at least whatever little we know, the trading volumes have been going up. We have over the last 4 or 5 years, we have seen that trading volumes have gone up significantly. And so that is one. Second thing, there are enough regulations and guidelines in case any ETF doesn't trade on a regular basis or bid-ask quotes are not available on an ongoing basis. Then there are guidelines available. One can go to the mutual fund and buy or redeem through the mutual fund basically.
Okay. So somebody has asked, in the last few years, ETFs and index fund have suddenly become very popular. Why so?
I think that is one is becoming popular. They have become popular not only in India, but they also become popular globally. If you look at globally also, the AUM is more than $10 trillion. The $10 trillion means is 10 lakh crore US dollars outside. In India also, if you look at the total asset under management is approximately 4.58 lakh crores. And if you look at the growth of the ETFs have grown almost 14 times over the last 5 years. And as I mentioned in my presentations earlier, what are the reasons? One is the cost. Fund management fees are very, very low. As I mentioned again during my presentation, in the case of ETFs, the fund management fees could be as low as 0.03%, 0.05%, and going up to 0.5% depending on the fund, the ETF. Wherein in the case of active funds, the active equity fund, the fund management fees could be anywhere between 1 to 2%. So that itself is resulting into some kind of a cost saving. That is one. Second thing is increasingly, and especially in the large cap funds, the fund managers are finding it difficult to outperform. I would say majority of the fund managers are in the large cap funds or other funds are finding it difficult to beat the performance of the indices. And so if majority are not able to outperform, then it becomes difficult for the investor to keep tracking or keep investing in an index, or sorry, to invest in a fund which is outperforming the index. So best is to invest in index funds or index ETFs, which will give you the market returns without having to bother whether my fund is going to outperform the index or underperform the index.
Sure. Now there is a suggestion requesting to continue this kind of training or webinars for the new investor at least once a week, because then people will be benefited.
No, I think that is our endeavor. In fact, we have just started. Today is the first session that we are conducting. And our endeavor is to conduct a series of webinars on ETFs and starting with the basics and going into some more details. And we will, I think, thanks for your suggestion. And we will continue to have these sessions as we move forward. And some of these sessions will also be available on our website and also available on YouTube. So we will do that.
Okay. Another question is, can an ETF outperform the underlying index?
Theoretically, it looks difficult because you are investing in the same stocks as the underlying index. And on top of that, you have various expenses. So, and expenses will be there. So it is theoretically, it is difficult to outperform the index, at least the Indian part of it.
Okay. Okay. Now, there is one question on one of the slides where you showed that in large cap category, 4 out of 29 funds beat the Nifty 50. The user is asking, are there any similar data points for other categories?
So there are studies available in the market which gives you category-wise mid cap, small cap, large cap performance vis-a-vis indices. There are studies available in the market. Like one is, there are studies by other players, noted other index providers, which are available in the market. Yeah.
Okay. Okay. Another question is, where can we find the historical daily data for index funds and ETFs? Historical daily data.
So I don't know, Rohit, that question not with what daily data?
I think they would be asking about NAVs, daily closing NAVs and all.
See, closing NAVs and all are available on the mutual fund website. As I mentioned earlier, even the live NAVs are present on the mutual funds website. And it's a very important thing to look at before buying any ETF. I would say that before you decide or when you are placing your order for or you're buying any ETFs, please have a look at the live NAV and ensure that you're buying that ETF as close as possible to the live NAV. So NAVs are available on the daily. Prices are available. Closing prices of ETFs will be available on the stock exchange website. Live bid-ask, top 5 are available on the exchange website. So I think data is available in public domain, either the exchange website or the mutual fund website.
Okay. And are international ETFs also available in India? International underlying ETFs also available in India?
Yeah. There are a lot of international or ETFs available which are tracking the international indices. As I mentioned earlier, there are ETFs tracking NASDAQ 100. There are ETFs index funds tracking S&P 500. There's an ETF tracking S&P 500 top 50, Hang Seng Index. And this year in particular, a lot of new ETFs and index funds have been launched, which are tracking the global indices. So that's the beauty of ETFs and index funds. You have entire basket which is available. I can invest in equities. In equity, I can invest in large cap, mid cap, small cap. I can invest in banking, private bank, IT, pharma, healthcare. And similarly, I have debt funds. Debt funds, I have gilt available, government securities. I have corporate bonds. I have SDLs. SDLs is state development loans. So I think there's a wide choice available. Similarly, I can invest in global markets through this index funds like Nasdaq 100, S&P 500. Similarly, I can take exposure to gold also. All of us are very passionate about gold. Why do we want to buy gold, underlying gold? Why not invest in the gold ETFs? And as and when I want to have gold with me, I can sell the ETFs and buy, or index funds and buy gold. So you have a wide variety of asset class on which the ETFs and index funds are available.
Thanks, Mukesh. I think we have covered at least most of the questions which we can see here. Some of the questions are a repetition also. That's why we are not doing it again. And we are almost now close to 1 hour. So Mukesh, any closing remarks from your side to close the session?
No, I think, as I mentioned earlier, ETFs and index funds are becoming popular, and we at NSE believe that increasingly they will become more popular. The kind of flows which we are seeing in the industry, the kind of products being launched. So we at NSE are very, very excited, and future we will keep seeing new index funds, new ETFs being launched, and larger inflows will happen. Like first 10 months itself, almost 90,000 crores of fresh inflows have taken place into passive products, which is larger than any of the past years. And going forward also, we expect the trend to continue. And similarly, a lot of new folios have been created. So if you look at it today, both index funds as well as ETFs, we have around 1.12 lakh crore folios, 1.12 crore folios, and out of which 90 lakh folios have been created in the last 2 years. This just shows the increasing popularity of passive products, and this is only going to go up, because I know we as an index provider, what is the pipeline of indices on which we are working. We are working on a lot of exciting ideas, and products will come out in the market soon. So it's a good thing. I think one needs to have a diversified asset class, and one should consider passive products as part of the portfolio, part of their portfolio. And one should look at investing in passive products. That's all from my side.
Thanks, Mukesh. Thanks for your closing remarks, and thanks to everyone who joined this session. We will be organizing these sessions on a frequent basis. So try to attend as many sessions as possible. Once again, thanks a lot.
Thank you, everyone. Thanks, Rohit. Thank you, everyone. Bye. Have a good evening.